Welcome to the fourth annual edition of DoubleLine's Roundtable Prime. The new year appears to offer cyclical downturn in a landscape of secular change as the world looks to be on the threshold of global recession. Moreover, trends that for decades have driven economies, markets, monetary policy, and governance might be staging reversals. Join our six thought leaders as they analyze the macroeconomic state of play, offer market outlooks, and share their best investment ideas. Your host is Jeffrey Gundlach, CEO of asset manager DoubleLine Capital. Moderating the discussion is DoubleLine Deputy Chief Investment Officer Jeffrey Sherman. Our distinguished guests are James Bianco, President and Macro Strategist at economic consulting firm Bianco Research; Danielle DiMartino Booth, CEO of economic and financial research firm Quill Intelligence; David Rosenberg, President of economic consulting firm Rosenberg Research and Associates; and joining Roundtable Prime for the first time, Charles Payne, Fox Business News anchor and host of Making Money with Charles Payne, and author of Be Smart, Act Fast, Get Rich, and Unstoppable Prosperity.
All right, welcome back to the fourth annual Roundtable Prime. I'm Jeff Sherman here with our distinguished panelists, and we've just heard from them on their various views of the macroeconomic landscape, and now we're going to pivot to what this all means for markets. And so, we've seen a lot of things in the post-pandemic era. A lot of them were excesses, right? Charles, you mentioned excess savings, which is a joke, right? Do you save or you don't? We've talked about the excesses of stimulus, right? Whether those are fiscal excesses. We've talked about monetary policy, but there were a lot of speculative excesses in the marketplace and people that used as barometers for what was kind of the flavor of the markets for a while there. And those were things like the meme stocks, right? They were crypto. Let's call it the SPACs, the NFTs. I noticed the NFTs are now called digital tokens, right? Because the NFT is toxic. So, seeing some of the evaporation of wealth in those assets, what does that connote to the other parts of financial markets? And so, is it something endemic there? Is it these were just fads and we shouldn't extrapolate that to the financial markets? How are you guys thinking about that as we sit here at the beginning of 2023?
So I kind of look at what you're describing, the memes and everything, as being on one end of the spectrum. But when you come in just a few notches and you look at a cap rate on a multifamily building at 2%. In 2007, the low was 4%. So we had speculation in more conventional areas of the market, but anything could get priced for anybody. So CMBS went nuts, ABS, single family rental, anything and everything could get priced. And I think what we're seeing today as the speculation begins to come off is that one and two notches in on that risk spectrum, it's getting more and more difficult to find funding. And I think that there will be ripple effects in the financial markets this year. Opposite end of the spectrum is the duration and the high yield corporate bond, all the refinancing that was done. That's a safer area, and that's being reflected in spreads. But if you look at pricing for a triple B CMBS, I mean, it's double digits, and it's double digits in 6 months.
The thing I would say, as far as like meme stocks and to a degree crypto, I don't equate that necessarily to people buying pets.com, because there's an element to that that's anti-establishment, anti-elitism, sort of a lot of folks who are saying, hey, if I buy this particular asset and it goes to zero, I'm fine with it. I'm trying to buck the system. And so in that respect, there's a big difference between the runaway kind of, buy the hottest stock out there, move over a little bit more to the IPO and SPAC markets. This is where I have a big problem with Silicon Valley and Wall Street over the last 20 years, that they have taken advantage of Main Street investors so badly. It's really should be criminal. And this is how you get a Sam Bankman-Fried, by the way. This is why Sequoia would fund him twice and then put out a beautiful article on him in August of 2022 where he brags about not reading and disses people who do read, because they knew that there was a way. They have a feeder system where all the elites get a bite at the apple at a greater and greater valuations. If you look at the price to sales ratio of IPOs in recent years versus back in the day, remember when companies would go public? IPO to 20, open at 30, is at 40. How much money did they leave on the table? It was a crime. It was a crime that you left a nickel on the table. And I think it was the Facebook IPO that they kept raising the price and how many shares, raising the price and how many shares. The notion that you left a nickel on the table for the public to get a nickel was incensed the reporters and incensed Wall Street. And 1,033 IPOs and SPACs, extraordinarily overvalued. And I'm not just talking about the most obvious, some of the more obvious things, but Uber, it just went public at a valuation that was just mind-boggling. So, yeah, there was excitement out there, but Wall Street and Silicon Valley preyed on that excitement. They took so much advantage of Main Street, and this is Main Street understands something is wrong. So the crypto stuff, they're hoping, hey, I can own a currency that skirts government intervention, that skirts the establishment, that truly, in their minds, may ultimately give me financial freedom, which is always my destiny. My financial destiny has always been in the hands of the establishment, and I've always been a cog in their system. I go to the store and I buy a pair of Nikes, and they make more money off than Nike stock, in the meantime. So people are looking. They're trying to find a way around this because they know that the system itself is not looking out for them. And that's what makes it more of an extraordinary time now than during the tech bubble.
I think that's right, but I think it's even one step further than that, because not only are they kind of sticking it to the man a little bit, they're doing it with the man's own money. That's why I don't care if it goes to zero,
right?
Because they're playing with the house's money.
Right. Someone sent you a STEMI check and you put it in the crypto.
Yeah, we'll see what happens.
Yeah.
If it goes to zero, I'm where I was last week.
Yeah. Jim, you've been a big proponent of DeFi and everything as well. Has anything changed in your thinking, or what's your updated thinking, I should say?
Yeah, there's been a lot that's changed. In the previous panel, when we were talking about in macro, and I made the comments, Jay Powell wants to break the Fed put. You could see it in a lot of the meme stocks in crypto that they became completely out of control with their speculation, and they're blowing up really badly. Ed Chancellor just wrote a book called The Price of Time, and it's a history of interest rates going back thousands of years. And one of the interesting things about the book was, a lot of people didn't realize this, I certainly didn't until I read the book, we actually invented lending and banking first as a civilization. And then we realized we needed a more efficient medium of exchange, so then we invented money. But lending and banking came first. The crypto market did it the other way. They first invented their money. They invented Bitcoin and Ethereum, and then they said, okay, now we need a tool to do something with it, and they tried to invent DeFi. And I think that going that way, by inventing the money first, they encouraged way too much speculation. And now we're blowing up a lot of these cryptos, and we're hopefully going to come back to a new financial system without all of the casino aspects of it and try and rebuild it. Getting back to this excess speculation, I think it bothered Powell, and it should have, because it was a lot. And do we have it today? Yes, we do, in a big way, and we have it in the options market. As late as November, they finally started issuing daily options. There's options every day that are issued at the open on the New York Stock Exchange, and they wind up maturing at the close that day. That is nearly, they call them 0 DTE, 0 days to expiration. That is nearly half the volume in the options market right now. It's people trading options that expire in a few hours. And it is the new meme stock or crypto, and it's all in the same names that we all love, the FANG stocks and some of the other high flyers as well. And it's all the same thing. It's all this degen, short for degenerate gambling. And that's why I think that we're not past this yet. We're in the process of bringing the excess speculation out. We've done great damage and done a lot to get rid of the speculation in crypto. Maybe we'll get back to DeFi. We're doing a lot in getting rid of the speculation in things like ARK and Tesla, and there's a little bit more to do, but we're not all the way there yet. we've still got this massive amount of casino mentality. I used to say to myself, why did everybody get so upset of Sam Bankman-Fried? What did he do? He shined a light on what we all do. We all just massively, we can't tell the difference between the corner Broad and Wall in Vegas at this point. And that's kind of the way that we treat these markets. And like I said, I think a lot of that was stimmy checks. I think a lot of that was the Fed's got your back, that you can't go wrong by doing this because either the market will go up or the Fed will make it go up. And that mentality is coming out of the market, but we're not all the way there.
But Dave, isn't this just a classic business cycle? It's like, do we work off the excesses, right? There's speculation. There's businesses that probably should no longer be financed. Isn't this a similar kind of attribute of every other business cycle?
Well, look, every cycle does have its own unique characteristics and peculiarities, but patterns reemerge. And in answer to your question, it really comes down to interest rates, right? As my favorite economist of all time was actually a Nobel laureate in physics, Albert Einstein, who famously said that the power of compound interest is the eighth wonder of the world. So it's all about interest rates, right? And so there's always different culprits where the excesses lie, and then they get exposed in the interest rate cycle. And interest rates, if you look at, Jim brought up the history of time, and just taking a look at the history of these centrifugal forces. These are sine waves that intersect between markets, the economy, and interest rates, and inflation. So, as Bob Farrell famously said, there are no new eras, and so there's no new eras. And it is so. In some aspects, you're quite right. Interest rates drive the cycle, and interest rates drove the cycle one way, then it drove the cycle the other way, and we've seen this going back well before World War II. The Homer and Scylla text on the history of interest rates will just show you that interest rates dominate. We'll be talking about something else. I actually intend on becoming very bullish. If my thinking is on, I will be shedding my bear market fur, and will be turning very bullish for 2024. But the reality is that, and Danielle made the point earlier as well, and we all know that interest rates operate with lags. I said that last year was a rate shock, just as you would say that 06 and 07 was the rate shock, and then the payback from the rate shock was in 08. 1999, 2000 was the rate shock. 01 and 02 was the payback. 1988, 89 was the rate shock by the Fed. 90, 91 was the payback. The lags. This is the year of the lags. And so, in answer to the question, I would just say, once again, in terms of we're talking about the markets, I think we have to be reasonable people here. And there's going to be bear market rallies along the way. We had 8 of them last year, and you can trade them. Okay, you can trade them. But they're not the fundamental lows. And in terms of the levels that I'm looking at in the stock market, I'm saying put the multiple, the appropriate multiple. If we're talking about, let's get to something that makes sense from an equity risk premium, got to slap a 15 multiple at most on recession earnings. And I think if you don't think there's going to be a recession, you got your head in the sand. And it's not a medical diagnosis. It's just part of the business cycle. So you've got to put a 15 multiple on recession earnings, and you're below 3,000 on the S&P. So there's more pain to come. And so I would say that if you have to be invested in equities, I say defensive growth. I say you want to own what you need. Don't own what you want. Don't own the cyclicals. Own the utilities. Own the staples. Own healthcare if you have to be in the equity market. And as we saw last year, everybody's talking about value over growth, value over growth, value over growth. I think we had record inflows. Imagine in a year where the market was down 20%, record inflows into value funds. Think about that for a second for people that don't think that were priced for recession. Record inflows into value funds. The Dow is the poster child for the value trade, was still down about 10%. So if you're an absolute return manager, still not so good, even though he quotes you outperformed. But I'll say this much. I think that if Jeffrey Gundlach and I are right on our bond call, and we've already had some serious compression. I mean, you have some And I think Charles had mentioned about, this isn't about pets.com. These are Google and Microsoft and Apple. These are real companies. And the reality is that they are classic growth companies, which means that the direction of long-term interest rates is going to have a big impact on their valuations. I'm not saying I'm bullish right now on this particular group, but I'll say right now, I probably will be turning more bullish on growth in the second half of the year than I will on value. I'll take the other side of that crowded trade.
Yeah, and you're thinking about it from a rates perspective, but what about the big elephant in the room? And I know you brought up certain sectors of the market, but what about this whole private market versus public markets? The disconnect we've seen there in terms of valuation, and maybe it's the precipitous decline in the public markets, but is there a problem here? Or is it just that at some point it gets smoothed out? I think Cliff Asness calls it volatility smoothing or something like that. He says it tongue in cheek, of course. But is it a problem? Or is it enough of the big boy market where you're supposed to be sophisticated enough to get in there because you're a qualified purchaser and accredited investor, and therefore you should be able to get through it? So what's the take on the private markets today?
So big picture. 2020, $220 trillion, the size of the non-bank financial system globally, versus $180 trillion of the conventional financial system as we think of it. Now, remember that $220 trillion bigger piece of the pie is not regulated in any way, shape, or form. And I'm not pro-regulation, but talk about advantage having been taken. I mean, you tell me, Jeffrey, did private equity belong buying nursing homes, dry cleaners, going so far down in terms of the capital, the size of capital that they were investing in Main Street America? I mean, this is not barbarians at the gate here.
It's because they had excess cash because everybody's piling money into it, so they had to buy something, right?
But U.S. public pensions own 68% of the private debt market. Do you really think Grandma, the retiree, knows this? I doubt it. That she's further out on the risk spectrum than leveraged loans. And yet we see the Wall Street Journal run a story quietly on the 31st of December that no syndicated loans were done in the last month or so, but they were all filled in by private debt. I mean, is there something wrong here? There is, and the questions are beginning to be asked. And my biggest picture, my biggest theme going into 2023 is that when you see B-REITs and buying time, it's emblematic of the fact that private, for the last 40 some odd years, privates never had to mark to market. The Fed puts always kicked in early enough that they had enough time to buy that they could mark to target and not have to take their lumps. If Jay Powell succeeds, and that's why Jim says you don't want to see what it looks like. If Jay Powell succeeds, then you could have public pensions being forced to market in Q2, Q3 of this year, and they can't even tell you what the fee structure is of some of these holdings.
Whenever you have a big bust, it's usually preceded by blank check writing and shooing of kind of more standard investments. And this go round, I talked about earlier, we had a massively overvalued bond market in the beginning of 2022. The stock market was very, very overvalued. And when people notice that traditional investments aren't working for them, they don't have a high enough target like way back in 1993 when the bond market, people thought rates were super low because they had operating budgets of 8% and the interest rates were at 3%. And so they started doing crazy things. But this one's at another order of magnitude because you say with the inflation rate going for sure to 4%, this 1% bond market is laughable. And the stock market is at this incredible valuation. So what people want to do in those situations, they're forced out of need because the things that they think they can analyze are so unattractive, they just want to cover their eyes and put it in something that they don't even know what it is. Because if you don't know that it's necessarily bad, you got a shot. Because the things that you know are truly going to be necessarily bad, you want to eschew them. And that's what ends up happening. So you get all this nutty behavior, and then it gets, of course, put on steroids with, again, the house's money. And so I think that when you look at the valuations of the FANGs and so forth, once they broke, and I talked about this in 2020, I said, this is over. This FANG outperformance is over. And once we go through this throwover, it's going to go all the way back down to where it started. So if you look at some of these FANG type of stocks, where the level they broke above when the pandemic money came. So there was the big meltdown, and then it took out that high. We're going back to that level. And that's another 30, 40% down from here.
And what does that say about private?
Well, private is, you make a great point about the mark to market, because one of the greatest sleight of hands, I guess I'll say it in a friendly way, is this risk-adjusted return on private equity. Because you have a market that goes down, and it goes down, say, 30%, and they mark them down 12. And then the Fed put kicks in, and the market goes back up to 100, and they go back up, and hey, look at this, we've got the same return, but a third of the volatility. And it's the biggest myth ever, because it's just simply not mark to market.
I mean, in a year when REITs were down 20%, your town, Chicago, their municipal pensions said that their real estate privately got 10% on the upside. There's just a little 30% delta there.
Yeah, they make up the numbers just like the Fed makes up the numbers as well, too.
Touché, Jim.
Yeah, exactly. If I could riff on something that Dave said about being interest rates, one of the tighter correlations, what we saw in the last year, is you can calculate a duration on stocks. And a lot of it has to do with the expected earnings. So high growth stocks, they don't make money now, but they're expected somewhere in the future to make money. And as interest rates go up and you discount back that future gain, that your clean energy or whatever hot moment you're taking becomes worth less. And so you saw like the non-profitable tech, the ARC stocks and all that, all got crushed. And that, I think, comes back to interest rates. That as interest rates went up, a lot of these growth stocks get crushed and the value stocks do better. If we get to a period where interest rates plummet and the economy starts to recover, then all of these speculative assets that have this promise that they're going to pay big in the future become worth more. So don't discount the idea that, I've been as critical as anybody, saying that the market acts like a junkie for cheap money and it wants bad news as good news because bad news means a pivot and it's going to rally and good news means no pivot and it goes down. There's a certain logic to that. Doesn't mean it's correct, but there is a certain logic there because of the duration of stocks or the duration of earnings, and it all comes back to the discount rate, which is market-based interest rates.
So Charles, a lot of times we see in markets the last shall become first and the first shall become last. We saw a lot of that last year. So looking across kind of the U.S. equity market, obviously energy was the lone standout there. Utilities were close to a positive return. What are you thinking about in terms of some of these reversals? You call yourself somewhat of a contrarian.
Yeah, I am somewhat of a contrarian. It's interesting because some of the up days in December, you saw, the names that have been hit the hardest, up 5% in one session, that kind of thing, And that's usually the route that it goes initially, and before it starts to smooth out and there's a sort of a normalization. But there were still a lot of names, and when you mentioned clean energy, Enphase, SEDG, First Solar was up huge last year, that are still mostly, you think about governments, particularly Western governments, and the amount of money they're putting into these areas and what they're going to force people to do, but they're still way ahead of fundamentals. I went into Enphase 3 times last year and did extremely well every time, but I was like a long-tailed cat in a room full of rocking chairs. Like any day I would wake up and they'd say, but we ain't making money for like another 50 years. And someone would admit something like,
Right.
And so I got out of it. I was like, I'm going to hold on to this. I told my subscribers, we're going to hold on to this for like at least a couple of years. Don't even worry about it. But they go up so fast.
Fair market rally is better than real thing.
Right.
So, particularly those kind of names, like, 25% in a week. So yeah, I think that we'll get that. We started seeing that scenario late December last month, and we'll get a little bit of that this year too. You got to be very nimble sort of trader to kind of take advantage of it. To a degree, I'm with David in the sense that I think the first half, I love a name like United Rentals, URI. In the second half, I'd be looking at CrowdStrike. Again, under the thing that we've gone, the Fed's given us the wink. Maybe we've had the first rate cut, get that little bit of a pullback because it's a sobering effect that if the Fed has to cut rates, the economy really is bad. and that means the top line is going to be bad, and all the engineering in the world won't make the bottom line bad. One of the reasons, but I will say, with the earnings recession and everyone's talking about, I think when we get into earnings season, you're going to see so many earnings beats, in part because they'll finally catch up, maybe on consensus. But the engineering that goes on between the top line and the bottom line is just so amazing. You know, God bless Jack Welch. You know, it's like, you know, who could always find a penny here or there, right? So the earnings I think the earnings are going to be a positive surprise, really. The guidance maybe not so much, right? But so I still say if you're nimble enough, fine. Try to take advantage of that last is first, oversold, you know. Meta, right? How much is Meta up in a month? 40%?
I don't know.
Yes, Meta's up like 40% in a month. So, you know, these are names that are recognizable, high beta, they've been successful, the story is easy to tell, and there's a bunch of people waiting to jump in on, right? There's a lot of demand. You know, when that runs out and they turn around, fine. So you got to be nimble. I don't talk anyone out of that because they're amazing trades if you have the wherewithal to do it. But I'm still loving, like, again, I'm more, you know, the United Rentals of the world, industrials of the world. But second half, I will become very aggressive on some of these names. And they're still going to have higher multiples than normal, but they would have come down a lot from their highs.
So
Yeah.
can I ask Charles a question then? I talked about long duration, you know, earnings way out in the future got crushed. The opposite of that, short duration, is like energy. They're making tons of money today.
Right.
And they did spectacular in 22. Where do you
They
think
did
the short
spectacular.
duration, where are the short duration stocks going to be right now?
Yeah.
The ones that are making huge money right now, what would you do with those?
If I'm a conservative portfolio, I just hold them, right? I mean, I just, the energy stocks, well, first of all, you had energy coming down. I mean, energy is a two-part story, I think. One half of the year, energy went straight up, energy stocks went straight up. The energy came down, oil prices, you know, I mean, but energy stocks kept going up, and that was to the point where I don't think there's ever been that sort of gap before.
I think it was a record between what the stocks did and what
Right.
oil did. Yeah.
Right, and so that's what makes it pretty tough right now with some of these stocks. They're the cheapest stocks in the market. They have the best, you know, China's opening up and yada yada, the best story to tell. You would think they would be doing so much better, but you know, right now they're not. But the other side of that, we haven't really brought it up, is the dividends, right? I mean, people always talk about getting paid to hold. The Chevrons and the Exxon Mobils are the ultimate way to get paid, you know, get paid while you're holding a stock right now, because I do believe they'll make another run.
So thinking about this as well, you know, the out of favor trade has been fading the U.S., right? You know, international stocks, emerging market stocks. Where do you guys sit on that relationship today? And thinking from both a valuation perspective as well as a 2023 performance.
I just jump in every January in my show. Everyone loves emerging markets. Everyone, there's like a group, they love emerging markets, financials, and some, you know, everyone that comes on, in part because they're due. And it's like, okay, maybe it'll happen this year. I wouldn't be in the trade until I started to see it actually work. You know, trying to game it, guessing that, okay, now wink, wink, it's due, for a decade or so really has been, you know, the timing.
But the roulette table can't hit black 16 times in a row, can it?
You know,
The United States is still wildly overvalued compared to the rest of the world. The United States is still 2/3 of global market capitalization. I mean, come on. But
so at some point it's got to change. Yeah. Wink, wink.
But I will say this much, and this is, I have to give a hat tip to Mike Green. Passive is only 14% of some solid emerging market economies. Korea is but one example. When passive is this small of a portion of an aggregate stock market, it can actually provide liquidity to markets, as opposed to it's more than 40% of the U.S. stock market, and it's working in the opposite direction, which has amplified the move in the FANG stocks.
You know, if you break down the world, you know, and talking about the world every January, you take the Morgan Stanley, or the MSCI, All World Index. You could break it down into U.S., not U.S. Not U.S. is the same price it was 20 years ago. It has done nothing outside the U.S. for 20 years. That's why, Charles, everybody gets so excited, because it hasn't done anything. You know, exactly. One day we're gonna hit it with the paddles, and the pulse is gonna start again. You know, but yes, it is definitely due. But the rest of the world has been an awful place to have your money for the last 20 years. And then you look at the US and it's done like this, and it gets everybody worried. You know, mean reversion in investing is a very, very powerful concept that usually winds up bankrupting more people than it actually winds up being successful with. It works, mean reversion. The problem is you never know what the mean is you're reverting to. You know, so that's the little detail we forget about.
Do we really want to know what a world without a Fed put looks like? Do we really, really want to go there?
Yeah, you very well might be. If you want to look at the world less US, no movement for 22 years, that's a world that didn't have a Fed put.
Exactly.
Yeah. Jeffrey? Thoughts?
Well, I just note that the rest of the world has started to outperform the United States. You have to look at a relatively short-term view. But since the Fed went to 75 basis point chunks in raising interest rates, EM equity is basically up about, well, since November, it's up 15%. Now, that's not a very long analysis horizon, but the S&P 500 is up 3. So that's pretty substantial outperformance. And that, of course, is coincident with the dollar finally starting to weaken. And I think the dollar is going to weaken in the next recession. I think that the Fed is going to cut rates much more aggressively than the market thinks, and that is going to be impetus for the dollar to weaken. And that suggests that the trend change that has occurred may have some legs to it. Also, Europe, now you have to hedge out the dollar because the dollar has been very, very strong since 2020. But the European, just the price of the MSCI Europe has outperformed the S&P 500 for over 2 years. And I think that's interesting. And given that I think Europe is going to be relatively more hawkish than the United States in 2023, I think there's some continuation there. That got to the theme of the last shall be first and the first shall be last. 1 year ago, my favorite sector in the bond market was bank loans. And the only sector of the US fixed income market that had a positive return was BB bank loans, and also AAA CLOs, which are kind of the same as BB bank loans. And so other fixed income asset classes had returns of negative double digits mostly, with investment grade corporates down 15%, with EM bonds down 16%, investment grade AA's down 17%. These are big negative numbers, and bank loans actually made a couple of percent of the BB category. My thinking is exactly reversed for 2023. I think the bank loan market is going to experience defaults this year. If you look at financial credit tightening, lending standards tightening, there's a pretty good correlation between those standards tightening and default rates picking up on a 1 year lagged basis. That relationship now suggests, and I'm not really predicting this, I'm just pointing out this indicator, suggests that default rates could be 8% next year, 1 year from now, running an 8% annualized rate 1 year from now. And of course, the Fed has tightened interest rates. So that was a great thing when you have a floating rate coupon. The Fed raises rates 425 basis points, but since I'm quite confident they're going to be cutting this year, that trade's going in reverse. So you've got diminishing reward and increasing risk. And so that's not a place that I want to be. That's my least favorite fixed income sector. And when it comes to bonds, you know, talk about the last shall be first. Bonds were terrible last year. You know, I think that a mix of some of the credit opportunities, not in the junkiest stuff because of economic stress, but maybe BB, BBB, and not so much in the corporate bond market, but in middle capital structure of securitized markets, there's real yields available, unlike a year ago, but there's risk. But you have this ability now that you haven't had in about 10 years, that you can match up together a long treasury portfolio with a credit portfolio and mitigate a lot of the economic stress risk. So if interest rates drop, well, the copper gold ratio, one of my favorite indicators for starting out where the 10-year treasury might have fair value, suggests that the 10-year treasury should be at 2% right now. And so let's just say it goes to 2%. That's a pretty big drop. The long bond, you know, could rally 200 basis points under that scenario. So that's something like a 40% return. So if your credit stuff doesn't drop 40%, you actually have a hedge here. Now, depending on your aggressivity, the mix, what percentage you want in the treasury market and these credit opportunities is going to vary. But if you're a higher risk investor, you might do 2/3 credit, 1/3 treasuries. I think you'd be fairly well risk matched there. And the portfolio could yield something like 8 or 9% on a carry basis. And one thing about bonds, people don't understand, unless they've walked in the shoes that I've walked in for 40 years, that the price you buy them at matters a huge amount. You can buy a meta type of stock and go up 40% in a month, but a bond that's callable, bought at 104, which is where you were at the beginning of 2022, cannot go up, because if interest rates fall, it's just going to get refinanced. And if interest rates rise, you're going to lose money. But those bonds, in many cases, have gone from prices of 104. Now, they've risen since in the last couple of months, but from January until about October, some of these bonds went from 102 to 80, 70, 60. When you buy a bond and you feel confident in your credit work, you should expect some defaults. You're not going to get it perfect. But if you buy a collection of bonds with credit work down at 70 cents on the dollar, going up to 90 is not a problem. It's very, very easy. And so you get to a position where you have a bond market with opportunities of 8 and 9% with upside of 25%. That's 4 times the carry on the stock market. It's probably as much upside as you can dream of in the stock market. And I've got to believe that when you buy them at 65, you've got a lot of defaults priced in. When you buy at 65, it doesn't have to return 100. If it returns 66, you're making money on the price side plus the coupon. So we've gone from bond market ridiculously overvalued, I'd say versus stocks that may have been the most overvalued in my career, to a complete reversal, which is still in place for 2023.
Yeah. Anybody else comments on the bond market? Rosie.
Well, look, I'll say again, just looking at history, it's accounting 101. It's called FIFO, first in, first out, and this happens. So we talked before about is it a regular cycle? Well, patterns emerge. What you see historically is that the first asset class to go into the bear market is always the first one to come out of the bear market. Okay, this happens every cycle. So you want to look at patterns that reemerge 100% of the time. So the bear market in Treasury started, call it in August of 2020. The bear market in equity started in December of 2021. And the commodities, call it bear market, started in June of last year. Bonds are now, Treasuries came out of their bear market in October. The bear market in Treasuries is over. That is as much of a certainty as anything that we know. And it's not going to be a straight line. The one thing that we have to talk about, and I come back to, what does the equity risk premium look like when the bear market is over? And it's not 200 basis points. It's 425 with a very thin standard deviation, okay? So what are the combinations of Treasury yields and the S&P that get you there? Base case scenario, I said before, call it 3,000-ish on the S&P, 2.5% on the 10-year note. There's not a snowball's chance in hell that the equity market bottoms in advance of a substantial decline in Treasury yields. If you want to turn bullish on stocks, you've got to first turn bullish on bonds and then turn bullish on stocks. You've never had the reestablishment of a fundamental low in a recession bear market without the Treasury market holding the hand of the stock market. You go back, for example, once again, we have Jay Powell compares himself incessantly to Paul Volcker. Well, when did Treasury yields peak? In the early 1980s. The stock market peaked in the stock market bottomed in August of 1982. By the way, if we're talking about the Volcker put, you know what the Volcker put was, right? You know what the Volcker put was? 8 on the PE, okay? Treasury yields peaked a year before the bottom in the stock market. And this happens every cycle, by the way. And we're down like 150 basis points. So I think I'm in Jeff's camp. You want to turn bullish, we all want to turn bullish in equities, and we're going to get that opportunity. But it can't arithmetically happen without the Treasury market rallying. The Treasury market rallying is going to have 3 elements to it. The recession that causes the flight to safety, the disinflation, but also the Fed has got to basically take the carry down, okay, and re-steepen the yield curve. There's never been any evidence anywhere of the stock market bottoming as the Fed is still raising rates into an inverted yield curve. And there's never been any case where the stock market bottomed with the yield curve still inverted. Do you not see what I'm saying? That the Fed has got to cut rates. At some point, the equity market will be reestablished at much lower valuation levels. We had Act 1 last year, Act 2 this year, and we'll have a different Fed, okay? And so I'm very bullish on treasuries. And I think that the curve will, by definition, have to be positively shaped. There's going to be a lot has to happen. But the Fed will have to cut rates in the second half of the year, and maybe pretty aggressively. So I'd say curve steepener, bullish on treasuries. And I'd say right now, it's like Jeffrey is right. You get paid to wait. I mean, I would just say, why not just roll over 3-month treasury bills? You're getting a 4-handle, risk-free, no duration risk.
20% gain on the long treasury.
Well, but I'd say 100%, 100%. And by the way, I think that look how gold's behaving now. And this comes down to the question before to Jim about crypto. We did some work last year showing that the crypto craze drained through fund flows 20% off the gold price. Now crypto's been exposed as maybe not something that's exactly a ballast in someone's portfolio. And gold has rallied, like it rallied, didn't it rally today in the face of a super strong dollar or the past couple of days? Gold is actually rallying. But I was saying this earlier, by the way, gold has got to be part of your portfolio, especially with the weaker US dollar. But the other thing is that last year gold rallied in every single other currency except the US dollar. Yeah. People said, what's wrong with gold? Well, really nothing wrong with gold. And the bull market in the US dollar is over. And that's why I'll just come back and say that if I have to be bullish on any part of the world stock market, and it's a relative value trade, you look at the valuation support and a weaker US dollar plays into the hands of emerging markets on a relative basis.
So Rosie and I are going to be the guys that come up on Charles' show and talk up emerging markets at the beginning of the year.
Yeah.
We'll get it right sooner or later.
Yeah. You're young. We're all young. We'll keep doing it.
So to round this out, let's do something I'll call free asset allocation advice. So something we get from all of our clients. And I'll just start with you, Rosie. How do you weight those things you just said? What do you think is a kind of optimal allocation? You got to set it and forget it. We're going to revisit it next year, and we're going to look at it. What does it look like to you?
You mean for the coming year?
Yeah, you can't touch it. It's Rip Van Winkle, go to sleep. We'll wake up, and we'll look at it.
Well,
the good news is we can measure it, so we're going to hold you all accountable.
I'm trying to cut to the chase. You're talking stocks, bonds, cash.
Whatever you want. You can put any mix of any financial assets together. What does it look like? It has to sum to 100.
Well, I'd probably, I mean, there's parts of the stock market that I do like. Yeah. The parts that are non-cyclical that have tailwinds. Like one sector that was up last year was aerospace defense, right? And military budgets are going up everywhere.
10%.
Now, it's a very small share of the industrials of share of the S&P, but, I would say that, right now I'd be, call it 10% in equities. I'd be 60% in treasuries, or let's just say bonds, okay? Because I think, look, right now, I mean, banks in Europe and banks in the States are not going to be going bankrupt, okay? And I think you can get, like, correct me if I'm wrong, 5-6% on short-dated paper, okay, in the banks.
In IG, yeah.
Okay, yeah. So I would say 10% equities. 60% bonds, mostly treasuries, but not exclusively. And if my Hewlett-Packard calculator is right, the other 30%, I would be buying. I'd be buying physical gold. I'd be buying gold coins, and in fact, that's exactly what I am doing at the Canadian Royal Mint in Ottawa.
All right. You don't have them on you today. I'm just kidding. Jim, same question to you.
Yeah, hopefully you're burying them in the backyard too.
No, they're in the vault. It's okay.
It's a great.
The backyard might not be so safe if you know my if you know my neighbors.
Yeah. Gold is an amazing investment. All throughout human activity, we dig it up out of the ground and bury it back into the ground, right? It's all we ever do.
By definition, GDP, right? Digging a hole and filling it back in.
Yeah, exactly. Exactly. I'm viewing the question a little differently. Just some ideas, and the ideas that I have are more on the fixed income side. I'm having a hard time separating duration from the curve. I think they're kind of the same trade. And I like the curve trade better because I got two ways to win versus duration. I got one way to win. What I mean by that is I want to play the steepener in a big way. I'm going to win. Short, front, long, back. Yes. And so I'm going to win either because the economy craps out, the Fed has to cut rates, down come short rates, and you get my steepener.
Yep.
Or I'm going to win because the economy hangs in there. And Powell and Neil Kashkari are right. They're going to 5.5, and they're going to stay there all year. Then the bear market in bonds isn't over. We're going to go back through 440 on the 10-year, and that should probably steepen the curve from the deep inversion as bonds start to come up, realizing that maybe 5 is a longer way. I'm saying there's two ways to win on that trade as opposed to the duration trade. So give me 50% of the curve steepener on that trade. I like your gold trade. I do think that gold is finally starting to move. I completely agree with Rosie that gold has been suffering at the hands of the other safe way to invest, and that was lose 90% in crypto. And now that everybody's gotten done with that, we're going to go back to the more traditional way of saving gold. So I'll put 25% of it in gold as well. And finally, I'm not as completely sold on the idea that the bear market in bonds is over. I think it will end in 23. But it still think that we've still got a little bit more pain probably in the first half to come. Second half might be a different story. So I'm going to come back to something I said earlier. I want to play short duration equities. I want to play any value-oriented stock that's making a lot of money now. That's where I want to be now. The growth stocks phase will come later when interest rates are coming down and the economy is recovering, but that's the earliest second half of 23, maybe 24.
Okay, Jeffrey?
All right, and it'll be 60% bonds, and it's going to be that mix that I talked about, treasuries and credit.
40% equities.
So
I've heard that one before.
So 40.
It works pretty well.
Yeah.
The reverse 60-40.
40, right, 40%, but it won't be that, though. It just sounds like it. So 40% the credit, 20% in treasuries, and I would prefer actually 10 years and longer for the price gain. It may go higher first, might get a better opportunity, but you said Rip Van Winkle, so you can't touch it.
That's right.
15% gold and 25% EM equity ex China.
All right. Charles?
70% stocks within that grouping, 85% US, 15% China. And if you wanted to just do US stocks with China exposure, the Nikes, Starbucks of the world, even Apple will probably get a reprieve. China's sitting on a lot of excess cash right now.
Savings.
As opposed to excess savings, yeah?
Question, you said 70% stocks?
Yeah.
But you see a recession.
Yeah, I'd see a recession, but we're talking about for, the whole year, right? If I had to just start in at the end of the year, I'm thinking the Fed will try to come to the rescue before the year is over.
Now Jim's rethinking.
Yeah.
He's like, man, I had that second half trade in there, man. Maybe I should.
Bonds 15%. I'm not as sophisticated as you guys. Maybe a TLT kind of thing. Gold less than 5%, but I've always been a proponent of just buying physical gold and putting it on a shelf somewhere or whatever. Not long ago, I was in my closet and the gold coin fell, and I'm like, what the hell are you doing? I'm like, when are you going to do something? They said, we're starting to move. I said, okay. I said, ask Rosie. I said, okay. I threw it back up there.
I bought you with $35.
I'm like, what the hell? I actually, one of those little mini bar things, it's all chipped up because it's so old. Like, what the hell, man? You don't do anything anymore. I said, nah, check it out. We're going to come back. Some Bitcoin. Less than 5% would be in Bitcoin, 5% in cash. And then, in the miscellaneous would be 5%. Bitcoin, some whimsical things in the art world. I've been collecting Alec Monopoly, so I may get a couple pieces from him, that kind of thing.
Lastly?
Carbon and platinum.
Okay.
I'm kidding.
Yeah. Is that the new silver and gold?
I'm not.
Didn't Marilyn Monroe sing about that?
A very good way to trade carbon these days because there's a real diamond exchange. Anyways, I digress.
Okay.
I would be way out on I'd be up in quality and further up in quality as the year goes on because I do think that second half, I actually think you're going to see some dollar strength in the very beginning of this year, once you hit that 4.6% trigger on the unemployment rate, all hell's going to break loose. But in the interim, I would be building up my portfolio to 70% in good quality corporates as well as long maturity treasuries. I would have 10% in cash, 20% in physical gold, 10% in emerging markets. Solid ones. Again, this passive phenomenon is new. So you're going to introduce liquidity into markets that are not used to it. And I would be short 10% stocks.
I was going to say, I don't think that's some
Yeah,
to
no, I know.
100. Yeah, but
I
okay.
think
okay.
small and mid-sized.
I didn't say you can't lever or you can't short.
I was
I
just-
said it's some to 100.
I'm just going to make a comment that I didn't hear the word real estate among the
Well,
five of us.
I'm getting right there.
Yeah, okay.
So
Right.
it's small and mid-sized banks.
I have to
are-
assume you're all long real estate at this point, though, right? Maybe not as long as financial assets, but yeah.
Small and mid-sized banks are really long commercial real estate.
Yeah.
And they've got issues because of the paper that they're holding, and the Fed forced them into what they're holding, and they're sitting on losses. They're in a pickle. The deposits are bleeding out. The big banks are in much better shape, but a lot of these small and mid-sized banks, I think, are extremely vulnerable. I would be paying attention to the Ares A REIT, which is kind of the younger, much riskier out on the credit versus Blackstone's B REIT. I would look to that for the lower NAV. And I would look to find ways of shorting some things that are blatantly coming down.